All right. Welcome, everyone, to yet another edition of TradeView Live. I'm your host, Ben Tracy, lead strategic business development at Vizion. I'm also going to be the co-host, but I've been joined here by a guest, Graham, but unfortunately, Kyle, our CEO, was not able to join. He's on a flight. Lots of flight delays, lots of things going on. Hopefully, with the government shutdown ending, we'll see some of those delays in the airports get a little better. But thank you, Graham, for joining as our guest. Go ahead and introduce yourself to the audience. And yeah, we'd love to hear more about ShipAngel.
Yeah, thank you, Ben. Thank you for having me on. Big fan of you guys, and happy to have you as partners on our new booking platform, powering our visibility. Hey everybody, great to be here. My name is Graham Parker. I'm CEO and co-founder at ShipAngel, which is a ERP suite of products for international supply chain for shippers.
Wonderful. Well, thanks for joining, Graham. Excited to get your perspective on some of the trends we've been reporting on since April, but especially with what's happened in the last 2 weeks. So our typical disclosures, what is TradeView? For any of you newer to TradeView Live, TradeView is a platform that Vizion offers, covering over 57% of all container shipment bookings or transactions. We profile the companies and the types of cargo and the transportation networks in each of these bookings. We have many different AI tools to deliver custom insights, performance monitoring and KPIs, and a few different flavors of that we show samples of during TradeView Live. TradeView Live, by the way, we're not here just to demo the software, here to really talk about some of the breaking topics and top headlines in supply chain, but to see what insight and what data from the TradeView platform we can offer. So the sources that TradeView pulls in from, everything from vessel satellite data to carriers and their schedules, rail operators, ports and terminals, and of course our unique access to bookings, which are of course placed well before the shipment even begins and very much a leading indicator in shipping trends and shipping demand globally. This allows us to see ahead of time what will be arriving, for example, into the US. We'll get into our US import forecast in just a moment. What are the initial responses, for example, to a new trade policy, a new tariff, a change in freight rates or capacity or congestion, and how are shippers adapting? So without further ado, let's get into what's happened in the last 2 weeks. There's been a lot. Whether you're paying attention to the government shutdown or our trade agreements that were announced with China to sort of back off some of the threats that were being levied on both sides at the end of October, what we've seen is very much a stabilization globally. This continues with what we were reporting a couple of weeks ago. But in the last 2 weeks, not much change. A slight decrease, and we're relatively flat year on year. Now, when I look at US import bookings in particular, we are continuing to see quite a drop in comparison to 2024 levels. And if I think about what was happening last year at this time, we had just exited the port strike in October, and what we saw was an initial front loading during what would normally be a pretty low season after peak season. This in 2024 was actually relatively high. So that could explain some of the year-over-year change we're seeing. But when we go into China to US bookings in particular, we are nearly 30% below our volumes from last year. So Graham, I'd love to get your perspective on what's happened since April, and how are your customers responding in terms of their shipping behavior, their ability to adapt to these relatively volatile circumstances?
Yeah, Ben, it's really interesting, and I think this data is really fascinating for anybody that's involved in the industry. It really gives you a kind of a deep understanding what's actually happening. If we kind of go back for a moment to those dark COVID years, particularly from the shipper group, it was obviously a very, very difficult time. And one of the, there was a few trends that we saw coming out of that. And one was that shippers wanted, in a lot of cases, a bigger portfolio of vendors, be that freight forwarders or carriers. If they had 2 of each, maybe they wanted 3 of each or 4 of each. And obviously, living on the rate side, we can see that, coming out of COVID as well, you saw there was a lot more surcharges. Carriers were opening up contracts more. And the result was that the shippers with more vendors were looking at, going from maybe being 75 to 90% of the portfolio being on annual deals to getting a mixture of, it suits us with some carriers to do an annual deal, but with other carriers, we might do a biannual deal, we might do a quarterly deal. We might have an MVO that we do a quarterly deal with. We might leave 10-15% of our options to go into the spot market, and we can see continually, from the summer onwards, that there's been a kind of a drive into that spot market in a lot of verticals, where companies are kind of flexing their muscles, where they're not tied to too many annual deals. Or when they front loaded from April onwards, they were able to get to a stage where they hit their commitments, allowing them to tap into that spot market or take advantage of the quarterly rates they have. Because in a lot of cases, those spot rates are now kind of below what those annual contract levels are.
Right. So it sounds like what's happening with all this volatility and capacity going up and down. You've got delays outside of Rotterdam. You've got potentially what is the tariff of the week, not just of the year, but depending on when your cargo arrives, you could be paying 2 or 3 times in duties what you normally would. It sounds like this favors a way of scheduling your freight that offers more diversification, more flexibility in terms of the way that you spread your allocation by different contracts. And so if you're working with a provider or you're working with a platform that doesn't offer that flexibility, you're at a disadvantage. You're potentially paying a lot more for your freight than you should.
Exactly, Ben. I mean, again, when you look back to kind of the pre-COVID time and you look at the percentage of shippers that were all in, or the majority of their volume was moving on annual contracts, we see a dramatically different world today, where again, they may have one carrier contract that's annual, but they'll have a second carrier that is say quarterly, an NVO that could be quarterly. And what that allows them to do is exactly like you said, like right now, when you're booking cargo, you're able to take advantage of those spot rates, which are dramatically lower. And as you can see from your numbers here for week of November 3rd, with the volume changes on US import bookings, particularly the China bookings, the carriers are kind of aggressively reducing those spot rates and looking to kind of fill up ships.
Yeah, that makes sense. So before we go into a deeper dive on the bookings, we have some more forecasts and China to US breakdown we want to do. Before we do that, I want to offer a new visualization. We haven't actually shared this before. This is an example of the type of analysis on performance that Vizion's data analytics team produces for our customers. So this is actually a snippet of a report that we produced for a customer. And apologies if the text is small, if you've got to zoom in on your screen, but I'll read you some of the highlights out of this report. So one is blank sailings. The Trans-Pacific trade lane showed that 67 China to US blanks and 71 US to China October blanks is actually going down to 45 November cancellations across both routes. So certainly a drop from where we were before. Second is that Asia to Europe blanks are sustained. And so maybe that's a way of controlling any potential drop in rates. But 60 to 75 total blanks over the next 90 days, with 48 December cuts have just been announced. The transatlantic trade lane is relatively stable, only about 15 or 20 blank sailings across 90 days. And as far as schedule performance and on-time reliability about 93%. Now, when we look at transshipment performance, that's in particular where you want to pay attention to not just the trade lane you're booking on, but what specific route and service string. How many ports is your container having to travel through to get from origin to destination? Right now, Singapore is experiencing some of the highest transshipment congestion, which we define as container dwell, including vessel weight and vessel berth times. So from arrival to discharge to loading your container onto the next ship and it successfully leaving, over a week right now. Ningbo has actually spiked recently to over 10 days, but some of the other major transshipment ports are stable at about 5 to 7 days of transshipment dwell performance. So all in all, I think what we might be seeing here, and Graham, correct me if I'm wrong, but sort of like a two-tier supply chain emerging, or a two-tier approach to how you want to schedule and manage your freight. One, premium reliability, but I'm assuming at a much higher cost, versus you could call them economy services, but right now are showing very much extended and potentially unpredictable timelines. Are you seeing something similar on your end?
Absolutely. And I think this is a fascinating part of the data set for me, Ben, when you're able to kind of drill into these kind of transshipment dwell performances and looking at the congestion. And it's not just, you're looking at a carrier and you're looking at a rate. You need to look at the loops you're on. And in this instance, if you're transshipping via Singapore right now, where there's high congestion, you're looking at a 7 or 8 day layover. That is very, very significant. And to your point, there's other ports that are premium. So this is really, really interesting to be able to kind of see exactly where the bottlenecks are. And on the blank sailing side, it's really interesting because the westbound and eastbound can kind of affect each other too. If you think to the typical pre or post Chinese New Year slump, where there's a lot of blank sailings, sometimes that can affect the equipment for US exporters, where if there's enough blanks, there's not enough equipment coming in. So it has a real knock-on effect. So this is really interesting for both importers and exporters.
That's a very good point. And we'll actually get into some breakdowns of US exports specifically to China in just a few slides. But no, that's a really great point, in that if the blanks are at such a point where there might not be the available equipment, the containers or the vessels over in the US for export, that's going to obviously affect our export capability as well. So yeah, no, all very good points. Let's dive a little bit into US imports. So we had, I think a few months ago, started to reveal our initial forecast, taking the model of the booking data, knowing on average how long these containers take to arrive into the US, and being able to predict, and it's within about a 5% margin of error, how many containers would be arriving and when. We released that model in July. We have customers that subscribe to this. And here's yet another sample, because what we saw in Q3, so ending in September, was a 12% year-over-year drop for container volumes going into the US in comparison to 2024. Now, the biggest question was with a lot of these tariff deals coming into place and the reduced tariffs or backing off some of our big trading partners like China, would we see demand return to a volume comparable to last year's levels? Right now, for the freight that's on the water or scheduled to be on the water, arriving into the US by the end of the year, we are going to see an increased year-over-year drop. It was looking like it might be close to 20%. We've made a slight correction to that. We're at just over 16.5% year-over-year drop. So there were a lot of things going on last year. We, of course, saw some front loading. We had some freight that was on hold for a few days due to the port strike on the West Coast, on the East Coast, and the Gulf Coast ports that were shut down for a few days. But this is pretty significant. I don't know, Graham, if you have seen this type of seasonality where we're seeing a double-digit now, nearly 17% drop in TEU arrivals. most of this is going to be affecting West Coast ports. But is this somewhat unprecedented where we're at in terms of U.S. import volumes?
Yeah, I think the drop off here is very dramatic. Again, like you said, we saw a lot of front loading in April, which really worked in the carriers' favor, because that was exactly where the contract season hit, and it allowed the carriers to kind of get a lot of the contract levels that they wanted to for the season. But if you just fast forward kind of 6 months to now, like you say, it's dramatically different, and I think it shows that importers just do not have the confidence to kind of hold stock. There's obviously been lots of challenges throughout the year with shipping, but I think this view gives you a clear understanding too, that this takes everything into consideration. If you've got your China plus one strategy up and ready, and you've moved some of it from China to Indonesia and Vietnam, that's taking all that into consideration at the moment. It's certainly the most dramatic I've seen in a long time.
Yeah, absolutely. And I think there's maybe a small consideration here. I'm realizing we saw a spike in volumes at the end of last year, specifically for freight that needed to arrive into the US before the Chinese New Year. Now, that Chinese New Year in 2026 is going to be a few weeks after it was in 2025. So that could be playing into some of this significant decline, especially when we look at the last week of December. If I compare that to the year before, it's likely the biggest contributor in terms of that year-over-year decline. It's possible we'll see somewhat of a rebound in January, but we'll be following this closely. So let's look at a more historical context. We offered this slide 2 weeks ago to compare not only last year's volumes, but also 2023, when we talk about shipments from China to the US in particular. And we all know we were well below volumes for the last 2 years over the summer. When I look at, what is that, roughly week 25 until about week 37. And then, of course, we had that seasonal drop due to the holiday. And where we've returned when we were showing the slide 2 weeks ago is we were right at 2024 levels, and we were a little bit below 2023 levels. And so the question was, are we now going to surpass? Are we going to start to see China to US bookings actually increase year on year? And instead, what happened is we've gone in the opposite direction of that green line. Now, the color is a little bit close here, but the green is last year, and the blue line is 2 years ago. We're following the trend of the blue line, which is typical seasonality, in that you see a decline, but we're still well below 2023 volumes, and of course, significantly below what we saw in 2024, which was somewhat abnormal behavior, that sort of front loading. So this is, I think, a big contributor to what we were just looking at before, which is that 16%, almost 17% year-over-year drop. The China to US relationship, according to the headlines, whether you're looking at precious metals or the USTR port fees, it seems to be normalizing. But what we still see is a big amount of hesitation from shippers who maybe 37% tariffs now, maybe that's still too high, right? Maybe they're waiting for either that to drop below its current levels, or for the actual trade agreement with China to be ratified and it to become official. And so then when we look at exports to China, obviously a big part of our trade agreement with China was about helping to reduce the trade deficit. A big way to do that is by increasing our exports to China, getting China to buy more stuff from the US. And we have actually seen an increase in the last 2 weeks. So if I look at just how much that dropped after week 19, which was following the significant drop in week 12, that was April 1st when the tariffs were announced. Week 19, we saw volumes decline because things hadn't quite panned out in terms of finalizing our trade agreement with China. And it's crept upwards pretty steadily since then. And beginning in week 43, we had this increase where we are seeing an upward trend for sure. I think nobody can deny that. But again, in comparison to last year and in comparison to 2023, we are far below those volumes. So when we think about US exports to China, yes, maybe a very small bounce back. We're close to where we were at the beginning of this year, about 14 to 15,000 TEUs booked per week. But we are nowhere near the 18 to 25 to even 30,000 TEUs that were booked in the fall of 2023 and 2024. Graham, when we think about U.S. exporters, what are they paying attention to, and what could be contributing to such a significant decline over the last 2 years for U.S. exports to China?
Yeah, I think when you look at it here, Ben, and you compare where we are now to 2 years ago, it's literally half, which is dramatic. And to be fair, what we see on the rates is the export rate levels are, they've never been lower. They're 2 digits in a lot of cases to export a container. So it's certainly not kind of cost prohibitive from a freight side.
Sure.
I do think if you look at like the major commodities being kind of agriculture and recyclables, both of them have like significant pressure. I think some of our recyclable customers see a lot of pressure. One of them I spoke to yesterday talked about how China stopped buying from them and is now buying the same product from Mexico, which is probably a message. And then I think on agriculture as well, there's obviously been a lot of pressure, but I think the hope on agriculture, speaking to customers this week, is that the hope is that it started to recover, and hopefully we'll see something relatively dramatic in the next few weeks.
Yeah. So let's double click on the agricultural topic, because I think in particular there were a lot of headlines on the soybean trade. China typically prior to last year had relied on soybeans primarily from the U.S. And sort of switched over to importing soybeans from Brazil. I think the statistic in 2024 was over 70% of all the soybeans coming into China came from Brazil instead of the US. So when we think about that relationship and that particular HS code, which we're seeing in the bookings, I want to point out, first of all soybeans going into China are well below their volumes last year and the year before. So that's something to note. And this might be an instance of consumer demand, an instance of the available spending and just the appetite for bringing in this amount of volume of soybeans and soy-like products. And yes, we are well below last year volumes, and we are also well below volumes in 2023. But when I compare Brazil to China, I think we see something interesting that again has played out over the course of this year to no one's surprise, which is that, first of all, in the beginning of the year, China was importing much more from the US than Brazil being that orange line. And then what we saw following the Liberation Day tariffs in week 12 is an immediate drop for the import volumes from the US for soybean products. And I would have expected Brazil to kind of take off at that point, but it took a little bit of time until about week 26, when Brazil import volumes began to far exceed those from the US. And they were ahead of us, ahead of the US for quite some time. We saw even an additional spike in week 38. They're now very close. And 2 weeks ago, we were looking at this specifically to see where is the US going to trend in comparison to Brazil, and we are slightly above volumes from Brazil in the last 2 weeks. It's a very minor difference, but I think this is something we'll want to pay attention to as an indicator of maybe the overall relationship for US exporters to expect additional buying from China. In this case, for soybeans, that's starting to happen. Again, we're still nowhere near the volumes we saw in 2024 and in 2023, but starting to tick upwards. So when we think about maybe in the opposite direction, some of the metals, the precious metals that we'd like to buy from China, obviously the restrictions have been lifted on that. That's another deep dive we'll probably go into for the next TradeView Live session. So that's about all I have. Graham, any kind of parting words for our audience? Any words of wisdom before we wrap up?
I mean, I'm such a big fan of the data. There's nothing like kind of seeing exactly what's happening, through this data. It can really help you, if particularly our customers being importers and exporters, to try to understand, not just what happened a month ago, but what literally happened last week. We're big fans of the data, and we get a lot of value out of it, and would highly recommend folks that haven't kind of taken advantage of it to really double click. It's a huge benefit in this crazy volatile world, as we can see from all of those aggressive graphs.
Well, thank you, Graham. I mean, we appreciate the compliments, and I would say the same to you. It sounds like what ShipAngel is doing is unique. The flexibility you're offering for shippers, especially right now during such a volatile time, I think is incredibly important. Reach out to Graham, reach out to ShipAngel if you all are interested in learning more. And we do actually have a question that was just entered from the audience. Sorry, Brian, I didn't see you there a couple minutes ago. The question from Brian is, do we have insight into whether the drop in TEU arrivals is due to a lack of demand, i.e. consumer spending, economic slowdown in the US, or is it more a shipper-induced strategy, uncertainty around tariff rates, a shift in supply chain sourcing? They could be bringing goods into Mexico, for example, instead of into the US. Graham, how would you answer that?
I think it could very well be a mixture, Ben. I mean, there's definitely, again, in a lot of sectors, particularly when I think of our retail customers, stock levels in some places haven't moved the way they hope for, with the forward loading. But also, it has been a very difficult period, of trying to kind of navigate and understanding exactly what the number was going to be from a tariff perspective when you arrived here. Our kind of hope has been, and kind of in some ways remains, the point I made earlier about, like, if you're a shipper or a BCO and you can take advantage of where the rates are, it can make quite a considerable difference. If you look at like the average level of where the contracts were signed last April to where the rates are now, they're literally half in some cases, depending on the port combination. So I do think it's a mixture. I think some sectors have been kind of, we always look at chemicals as an example. I think that's always a kind of a forerunner as well when we look at our chemical customers' rates and volumes, because it's a great understanding of what can happen and what people are planning in the economy. Right. But I think it's a kind of a hope that the lower rates will stimulate it, and I do think that there's a lot of very clever shippers out there that are holding cards close to chest and can kind of execute large volumes when the conditions and tariffs and rates are just right for them.
Yeah, especially when we think about it's such a combination of different factors, depending on the industry, of course, whether you're importing furniture, very large items, but also items that you might be able to store for 6 to 9 months. So a lot of this product, a lot of this inventory that was brought in Q1 of this year, and a lot of it still in even Q2, might still be sitting in warehouses. It might still be waiting in DCs and in stores, and making it to shelves for consumers, depending on the product, of course, depending on the seasonality of apparel and what was brought in before, or of course larger bulk items like furniture. And I would combine that with the fact that the government was shut down for 41 days, and that likely has some kind of impact on consumer confidence, consumer spending, with the amount of employees that were furloughed and some of the benefits that were reduced. I think that's a contributing factor to the uncertainty, even though, like you said, rates are as low as they're going to get, right? They're not getting any lower to entice a shipper to book more freight than they were before. So what we have to see is some of those other factors, again, like the government reopening, some of these tariffs are now a little bit more normalized. And we need to give it more time to see if that means an increase in shipping volume.
Absolutely.
Wonderful. Well, great question, Brian. And Graham, thank you again for taking the time. Love to have you on as a guest. And we'll see you all again in 2 weeks.
Thanks for having me. Goodbye, all.
Thanks. Take care. Bye-bye.